December 10th, 2008. Outside, Manhattan looked exactly as it always did. Yellow taxis moved through wet streets. Office lights glowed across the skyline, restaurants filled with customers finishing dinner. Millions of people went about their evening without realizing that one of the largest financial frauds in history was about to collapse. Inside a luxury penthouse on New York's Upper East Side, Bernie Madoff sat with his wife and two sons. For decades, he had been one of the most respected figures on Wall Street, a successful investor, a former chairman of NASDAQ's board of directors, a man trusted by billionaires, charities, celebrities, and financial institutions around the world. But that night, the image finally cracked. According to court testimony, Madoff told his sons that his investment advisory business was a fraud, that he was, in his own words, finished, and that the business was one big lie. Not a struggling fund, not a temporary problem, a lie that had been running for years. His sons later told investigators they didn't sleep that night. By the next morning, they had contacted a lawyer and then federal authorities. On December 11, 2008, FBI agents arrived at Madoff's apartment. The man who had spent decades convincing the world that he understood money better than anyone else was suddenly facing a simple problem. The money wasn't there. It never had been. And the world was about to find out, to understand how Bernie Madoff fooled so many people. You have to go back nearly 50 years. In 1960, a 22-year-old Madoff founded a small trading firm in New York with money saved from working as a lifeguard and installing sprinkler systems. At the time, he wasn't famous. He wasn't wealthy. He was simply another ambitious young trader trying to build a business in America's financial capital. But Bernie possessed something that would become far more valuable than investment skill. He understood trust. As Wall Street evolved through the 1970s and 1980s, Madoff's firm became a pioneer in electronic trading, helping develop the systems that eventually became the NASDAQ exchange. His market-making business grew into one of the largest sources of order flow on Wall Street. By the early 1990s, Madoff had become one of the most respected names on Wall Street, serving as chairman of NASDAQ's board of directors, a position held by senior figures from the industry's top firms. That title mattered, because in finance, reputation often becomes a shortcut for proof. People assume that successful, well-connected people must deserve their success. And Bernie Madoff looked successful. He moved among financial elites. He sat on industry committees. He was a respected, familiar face at exchanges and regulatory gatherings. His investment advisory business seemed legitimate because everything else about him did. Then investors started noticing something unusual. While markets rose and fell, Madoff's reported returns stayed remarkably steady, often around 10 to 12% a year, with almost no losing months. Technology bubbles burst. Markets crashed in 1987, 2000, and 2008. Yet somehow Madoff's fund kept producing calm, predictable profits. Many investors considered this evidence of genius. In reality, it was one of the biggest warning signs imaginable. Madoff told clients he used a strategy called split strike conversion, buying a basket of stocks while using options to limit both gains and losses, producing steady, modest returns. On paper, the explanation sounded reasonable. The problem, prosecutors later proved, was that the trades described on client statements had not actually been made. Account statements showed positions bought and sold at specific prices. Many of those trades never occurred. Client balances appeared to grow steadily. The underlying money wasn't being invested at all. On the 17th floor of the Lipstick Building in Manhattan, separate from his legitimate trading operation upstairs, a small team led by employees including Frank DiPasquale generated the fake statements, trade confirmations, and account records that made the operation look real. Statements were printed using old computer systems and even backdated typewriters to make them appear authentic. Trade tickets were fabricated to match historical market prices. Returns were calculated to look plausible, not to reflect any real trading. The fraud succeeded not because it was complicated. It succeeded because the paperwork looked completely ordinary. Clients received professional-looking statements. The firm's main trading floor, visible to visitors, ran a legitimate, profitable business. Nothing about the firm looked like a crime. Meanwhile, billions of dollars flowed in. Wealthy individuals invested, charitable foundations invested, so-called feeder funds, investment funds that existed largely to funnel client money to Madoff, channeled enormous sums into the operation, often without telling their own clients exactly where the money was going. For years, new investor deposits were used to pay returns and withdrawals to earlier investors. This is the basic structure of a Ponzi scheme, but prosecutors and court-appointed investigators later concluded this was the largest Ponzi scheme in history, with paper account balances reaching roughly $65 billion at the time of collapse. The larger it became, the safer it appeared, and that made it even more dangerous. Not everyone believed the story. One person looked at the numbers and immediately felt something was wrong. His name was Harry Markopoulos, a financial analyst and former options trader. In 1999, his employer asked him to try to replicate Madoff's strategy and returns. He couldn't. The math didn't work. Real options markets didn't have enough volume to support the trades Madoff claimed to be making at that scale. Real investment returns rise and fall with markets. Madoff's numbers were too smooth, too consistent for too long. Markopoulos concluded there were only two explanations. Either Madoff was front-running his own market-making clients illegally, or the investment fund was an outright fraud. Starting in 2000, Markopoulos submitted detailed written reports to the U.S. Securities and Exchange Commission. In 2000, 2001, 2005, 2007, and 2008, laying out his math and his concerns. The SEC opened several inquiries over the years. Each one ended without finding the fraud. Investigations focused on narrow questions and never verified whether the trades described on Madoff's statements actually existed with his supposed clearing firms. The warnings sat in files. Years passed. The fraud continued. Looking back, one of the most striking parts of the Madoff scandal isn't that the scheme existed. It's that regulators were handed a detailed roadmap years in advance and still didn't follow it to the end. For years, the scheme survived because new money kept arriving. As long as deposits exceeded withdrawals, the illusion could continue. Then came 2008. The global financial crisis. Markets fell sharply. Banks failed or were bailed out. Fear spread across the world. Investors everywhere needed cash, and many turned to funds that had historically seemed stable, including Madoff's. According to court filings, in the weeks before his arrest, clients submitted roughly $7 billion in withdrawal requests. For a legitimate investment firm, large withdrawals are manageable. For a Ponzi scheme, they're fatal, because the money clients think they have doesn't exist as real liquid assets. Madoff's operation depended on one simple condition: enough new money coming in to cover what was going out. In late 2008, that condition failed. New large deposits dried up as the crisis deepened. Withdrawal requests kept arriving. By Madoff's own later account, he had only a few $100 million left to cover billions in requested withdrawals. For decades, Madoff had been selling an illusion. In late 2008, the illusion finally collided with reality. On December 11, 2008, Bernie Madoff was arrested by the FBI and charged with securities fraud. The news exploded across the world. As investigators from the FBI, SEC, and a court-appointed trustee dug in, the scale became clear. Client account statements showed roughly $65 billion in paper value. Actual cash losses, money clients put in that was never returned, were estimated at around $17 to $20 billion. Even using the more conservative figure, it remained the largest investor fraud by an individual in U.S. history. Thousands of victims, individuals, retirees, charities, and pension funds discovered that money they believed existed was gone. Some charities closed entirely. Retirees who thought they were financially secure had to go back to work. The emotional damage was often described by victims as worse than the financial loss. People hadn't simply trusted an investment manager. They had trusted a reputation built over decades, validated by titles, regulators, and silence. On March 12, 2009, Madoff pleaded guilty to 11 federal felony counts, including securities fraud, mail fraud, wire fraud, and money laundering. On June 29, 2009, he was sentenced to 150 years in federal prison, the maximum allowed. He died in federal custody in April 2021, having served just over 12 years of that sentence. The court-appointed trustee, working for over a decade, eventually recovered and distributed more than $14 billion of the stolen funds back to victims. One of the largest fraud recoveries in history, though still far short of total losses. Yet the Madoff story isn't really about one man or even one number. It's about how reputation can substitute for verification. For nearly 50 years in this case. It's about regulators who had the right answer handed to them repeatedly and still didn't act in time. And it's a reminder that the most dangerous financial products aren't always the complicated ones. Sometimes they're the ones that look the most ordinary, steady, boring, reliable. For nearly 50 years, Bernie Madoff didn't sell investments. He sold certainty. And when certainty turned out to be an illusion, billions of dollars vanished with it. And on a cold December morning in 2008, reality finally arrived at the door.